Hello, and welcome to this session by Starlight Top Professionals. My name is Josephat, and I'm delighted to present to you this training on behalf of Starlight Top Professionals. We have previously covered the areas of business taxation, cash flow management, and this is our third installment where we are going to be covering business internal controls. Karibu sana, and we trust that this is going to be of impact. This is going to add knowledge, and this is going to be interesting to the viewers. And we hope that you're going to learn much and even share to others who will gain value from this video. We're going to be covering business internal controls. Our agenda today, we are going to have an introduction. We talk about our services, the background of internal controls, a detailed discussion on understanding internal. Now move into our area of study today. We are going to looking at internal controls. Internal controls are very important for business. So any business that man or any investor who has set up a business without systems of control is setting themselves up for failure. And so we find it as Starlight professionals important that we are able to enlighten business people, investors, business managers, employees on the importance of internal controls. So what are internal controls? Internal controls are any internal processes, policies, or procedures that help keep an organization secure and in control of risk. The broad concept applies to diverse areas such as physical security, digital security, financial integrity, and legal compliance. The purpose of internal control in organization is not just to set rules, but can be considered as ongoing dynamic process, which is designed to improve reasonable assurance, meaning that the focus is on reducing risk, but cannot eliminate them completely. So key two things to highlight here is that they're just not rules. They're dynamic. They change with the environment because risks and fraud change. They're not the same as they were a year ago or 2 years ago or pre-COVID. And the other thing I want to emphasize or highlight in this is that internal controls aim to reduce risk, but cannot eliminate. Because as risk keeps evolving, and the aim is to reduce it to an acceptable level, which is not going to be of harm to the business existence and running. So let us have a deep dive now. Now we're going to start into the structures of internal controls. We have 5, and this is based on a framework called the COSO, the Committee of Certain Organizations of Threadway Commission. Internal control is people-driven. It's not just existing on its own. The people are the ones who implement this, who make it function, who make it run. Yeah, just like the way we have oil in an engine without oil will not function. So the people are important to internal controls. So component number 1 we're going to be looking at is the control environment. Environmental control is the foundation of all components, setting up the overall ethical behavior as shown at the top. So this is the behavior of the people who are the management, the top, the founders. It is the commitment of the management to set ethical values and integrity by setting up the standards for employees. Their risk-taking, decision-making approach for control, environment, and structure. A strong organizational structure with defined responsibilities and roles with appropriate delegation of authority makes sure the accountability. So control environment is the base, is the foundation of internal control. So it sets the standards, the roles, how our decisions going to be made, what kind of risk are we taking. It sets the standards for employees, the ethical values, the integrity levels in the organization. So this is the first component, which is control environment. We move on to the second component, which is risk assessment. Here we are talking about analyzing the environment and being able to detect and pick out the risks that exist in the environment of your business. So organizations must identify and assess risk which could impact on all achievement of their objectives. That this include internal and external risks. So internal risks could be employee fraud, external risk could be change in the economic environment, political environment. Risk assessment can be done by utilizing methods such as independent internal control risk assessment, regular assessment of risk within specific departments by conducting monthly or quarterly meetings, periodic review of operational and financial data for possible trends and potential risks and their documentation. So it is for an organization, it is important that risk assessment is done regularly so that we can be able to detect the risks on time. And yeah, so it is we check what are those things that can impact on the achievement of the objectives of the operations. The next one is the component is the control activities. Now, these are the mechanisms, the procedures we are going to put in place to mitigate the risks. Um, so these are the policy procedures that are carried out management directives to mitigate risk, which can be achieved by setting up controls for transaction or activities. Requiring so for example, you could require authorization, data comparison with different sources for accuracy, implementation of security controls to protect information and assets such as purchasing limits, approvals, implementation of segregation of duties, with roles and responsibilities to prevent fraud. So the next component after control activities is information and communication. So organizations must open all relevant communication channels between all relevant departments, meaning information must be communicated accurately and timely to the right people at the right time, both internal and external communications. So an organization needs to ensure that the flow of information, that risks, whenever risks are detected, they are communicated in time and measures, control measures are put in place on time. If the communication is not on time and accurate, then this could lead to the results of a risk undertaking and happening, the negative results of a risk taking place and causing negative impact for business. So the next component is monitoring. So we have set up, we've checked the environment, we've done risk assessment, we've put the control measures, we are communicating effectively. Then we need to now to be monitoring these systems we put in place. It's an ongoing and periodic thing. It's not static. It should be something that is done regularly by those in management and even by employees, those in charge of various aspects of the business. So those are the 5 components of internal control. So let us now address the types of internal controls. So we have preventive and detective controls. Preventive controls are proactive approach designed to stop irregularities and errors before occurring in the first place. Include segregation of duties such as authorization, record keeping, and custody. While detective controls, these are controls that pick up after the results of risks happening. So whether positive or negative, so preventive come before and detective come after. So detective are reactive and is a reactive approach, but preventive are a proactive approach. Then we have hard controls and soft controls. Hard controls are tangible controls such as policies and procedures, typically documented and enforced. Examples are security cameras, access badges, and locks. So these are tangible controls. Soft controls are intangible or less easily measured controls, often related to the culture and ethics of the organization, such as the tone at the top, employees' behavior. So hard controls, we have things like cameras, we have physical controls, locks, and access controls. Soft controls now, these are things that control the behavior of the people. No, so we have a tone at the top, how decisions are made, these kind of controls. Then we have manual versus automated controls. Manual controls are mostly performed by people, such as handwritten approvals, manual reviews of invoices, or physical inventory counts. While less, the automated controls on their hand are performed by computer systems or applications without human interaction, such as automated data validation, automated transactions approved based on predefined rules. And these automated controls are what we are moving on, or what we are already at in these times of machine learning and AI. So manual controls are very controlled by people, but automated controls will take the aspects of internal control to the next level and help businesses manage the risks with more proactively and more able to even to assess risk much better. So we have that is the third type of internal control. So the last one we have is key and secondary controls. Key controls are the critical ones that directly address significant risks, which are important to achieve control objectives. While secondary control, on the other hand, are supportive controls and not as critical as the key controls. So key controls are the primary, the significant controls. Yeah, secondary controls are they come in after the primary or the significant controls. They are supplementary. They are supplementary controls. For example, you could have in a warehouse you have the gate. So that is the primary control because that prevents anybody coming in. A locked gate prevents any intruder coming into the storehouse. Then now secondary, we have now the cameras. So the cameras are able to detect when anybody crosses the gate or and are able to deter them. So this is an example of a key and a secondary control. So we have discussed about four types of internal control. We have the preventive and detective control, the hard and the soft controls, the manual and automated controls, and finally, the key versus secondary controls. So we move on to fraud risk assessment. It is important to adopt a systematic approach for fraud risk assessment within an organization. This includes assessing asset misappropriation, e.g., theft of cash, inventory, or equipment. In risk assessment, let's consider fraud triangle framework. So we have something called the fraud triangle, which is the opportunity, rationalization, and pressure. So what's opportunity? The situations that allow for fraud to occur. So what are you assess when you're doing risk assessment, you ask yourself, what are the opportunities that are there that exist in my business environment for an employee or for someone to be able to commit a fraud? Then the other thing is rationalization, the mindset of a fraudster, which allows them to justify the act. So you ask yourself as an employer, think as like a fraudster, what are the things that could uh, how that could motivate them, that could how does a fraud you try and think, so how, what are the things, how do they think, how do they justify to themselves what they are trying to do? Yeah, for example, someone could be stealing and taking money from the business because they feel that they're underpaid, they're underappreciated. So those are the kind of things that they could rationalize and say that, yes, even I'm doing this because that my employer does not appreciate me, so I need to appreciate myself. Those are the ways and means of assessing risk based on the fraud triangle. The third one is pressure. The incentive switch drives the fraudster to commit the act. So what are the pressures that exist in the environment? You could have someone, a driver who you've given a vehicle and they are doing transport business, commercial, and there is high intensive pressure for them to deliver on targets, on the number of trips, passengers they carry. So this could be something that could be triggering them to commit fraud. So these are what I'm talking about in the fraud triangle. We have opportunity. These are the technique that helps you to assess the risks. The risks. So we have opportunity, we have rationalization, and we have pressure. So next, after identifying fraud risk, implement the appropriate internal control to mitigate them. Below are some of the key controls to prevent risks. So we are talking about preventing risks. Number one, we have segregation of duties, authorization of controls, reconciliation procedures, physical security controls, and establishing of whistleblower hotlines. So we have talked about segregation of duties, making sure that one employee does not perform all the duties in the operations of the business, setting up or authorization mechanism. So there is someone who there are levels of authorizations in a business. Uh, Next, we have reconciliation procedures like bank reconciliation, sales reconciliation, inventory reconciliation, physical security controls like gates, padlocks. We have security cameras, establishing a whistleblower hotline. So this hotline this is a telephone or an email or any other communication mechanism whereby an employee or anyone else can be a customer, can be able to share information or knowledge, credible knowledge or information about fraud that they are aware of. So these are mechanisms of controlling risks. So we move on. So now we're going to look at the limitations of internal controls. While a sound internal control program based on the COSA framework helps to mitigate risk, there are three major internal control limitations that all auditors should be aware of. So we're talking about limitations of internal control. We talked about that internal controls do not completely reduce risk. They reduce it, mitigate it to an acceptable level. And here we're talking about three major limitations of internal control. So we have one thing is collusion, human error, and unexpected issues. So what is collusion? What are we talking about in collusion? Collusion occurs when a group of individuals work together to circumvent internal controls related to segregation of duties to commit fraud. Additionally, it is not always possible to segregate duties, which can result in an increased opportunity for collusion. As such, it is important to have a solid understanding of all financially significant processes, including responsibilities for performing internal controls as job responsibilities change due to new hire, transfer, or termination to ensure appropriate monitoring controls to prevent fraud are in place and operating effectively. So this whereby individuals who are aware of the system, where you have set up all these systems we've talked about, but the person authorization and the person below them who they're authorizing their work or come together and work together to override, to defeat the systems that have been put in place. So this is a human aspect, and this is a limitation on internal controls that we're talking about, where people collude. Another limitation is human error. The effectiveness of internal control program will always be limited by the fact that human beings are not perfect. Some examples of human error that can impact internal controls include innocent mistakes made by employees when performing day-to-day responsibilities due to fatigue, distraction, employees misunderstanding instructions, and bad decision making based on limited information available. Common solutions for reducing the risk of human error include automating internal controls where possible, and implementing integrated technology to provide greater visibility into audit risk and compliance activities to stakeholders as needed to drive better decision making. So this is another area of human aspect, that people make mistakes, people are not perfect, and that is not changing. And therefore, internal controls will be limited by the failures of humanity. And that's why, as we had mentioned earlier, that the use of machine learning, AI, and other technology are going to help to overcome the limitations of humans. And so they are going to augment the human aspect, and we are going to have a better outcome. So the next thing, limitation, is that unexpected issues. So unexpected issues encompass all of the unforeseen circumstances that can impact a business, as there simply isn't any way for an organization to foresee all the possible risks that occur while simultaneously implementing controls to mitigate against these risks. Organizations that implement connected risk technology that enables users to perform dynamic risk assessment and continuously monitor risk levels in real time are better suited to identify and dealing with unexpected issues before they arise to a level of concern. So there are always dynamics that we cannot be able to predict or have not occurred in the past. And therefore, internal controls, we may not be able to address these new arising, emerging issues. And that's why we talked about efficient communication, agile mechanisms of picking up new risk. So risk assessment is an ongoing thing. It should not be something that is done once a year. It should be something that is continuous monitoring, so that we can overcome these limitations. So we talked about 3 limitations. We talked about of internal control. We talked about limitation number 1, collision, human error, and finally, unexpected issues. So those are the limitations of internal controls. So moving on. So why do businesses need internal controls? Small businesses need internal control because they have assets and information to protect. So you protect what you value, things that is of value to you. Because many small businesses lack internal controls, they are more vulnerable to breaches and fraud. When fraud occurs, it also costs small business a lot of money, which small business owners cannot afford to lose. So we protect what we value. And that's why it's important for business people to put measures, mechanisms to mitigate risks. Effective internal controls for small businesses help reduce theft and fraud, avoid losing money, build customer trust, securely grow the business, and prevent liabilities. So we are talking about reducing theft and fraud, avoid losing money, build customer trust, securely grow the business, and prevent liabilities. So these are what effective internal controls help businesses do. Moving on, the most important internal control for small businesses. So this we are going to talk about are the controls that are important controls for small businesses. So as we started, we are addressing our focus and our aim is to address businesses, to address startups, to address people who want to grow their business. And here we have important controls that are highlighting for you to consider. So sit back and let us learn and pick up this and see how we can be able to implement them into our operations. So there are quite a few, but let us start. The first one is separate financial duties. Many financial business owners and employees are jack of all trades. Financial controls help managers to implement checks and balances. So, as a business owner, it is important to have, if possible, if you are not a startup or a sole proprietor, have someone manage these financial aspects, because you are able to, someone who's going to pay attention and advise you. So separate this and just do everything: marketing, finance, sales, technical. Just, it's important. Even if you can outsource, you can be able to. There are people, they are skilled and who have knowledge, who can assist you to be able to manage this. So the second thing is have a separate bank account. So when people start small business, they often sole proprietors. If in this case, it's too easy to mix personal and business finances. So it's important that you're able to separate business and personal, because if you do not do this, the risk of misappropriation of assets, which is now in this case cash, is very highly likely to happen. So another one is to require background checks. So we are talking about employees. So when you are hiring employees, because they are a very important component of your business operations, it is important to do a level of background checks. Have you gotten their ID? If your business is highly sensitive, have you gotten clearance from the authorities? Yeah. Have you asked about if they are done some background checks of the referrals you got them this employee from? So these are the few things, and there are much more that you can do depending on the level of your business, and you can be able to make sure that you're able to put a guard at the start. Before some of they come in and you have issues, you're able to put a stopgap at the start before the person comes in. You're able to control this, and it's going to be of great value to your business. The fourth thing is that we have regularly inspect inventory. So if you are a business person and you have inventory, it's not enough to wait for month end to do inventory checks. You do have processes to make sure that even daily, if it's possible, that inventories are checked. The record keeping is current. The record keeping is current, and you can put a finger on the numbers that are reported in your books, and do not wait for long before checking inventory, because inventory, if not well managed, for especially for business which are inventory heavy, can be a pain, and can be a source, can be a place of heavy fraud in a business. So that is the fourth item: regularly inspect your inventory. So the next aspect we are going to talk about is implement access controls. Access controls are processes like giving designated login credentials to each employee. These internal controls for small business ensure that only verified users can access systems and data. So this is a very simple one, that there are areas that you need to make sure that not everyone can access the cash box, can access inventory, can access some offices. So it's important to put controls. Just Yes, it's important to you can have trust with it, but it's still important to put controls that are able to help you safeguard your business. So the other thing is to restrict access to financial systems and data. Many employees don't need access to all systems. So if you have bookkeeping systems, even your accountant, you need junior accountants. Then there's a level you can give them that they don't have access to the cash books. They don't have access to the inventory records on your accounting systems. So, and other, even they can't be able to access the bank information. They can't be able to, or to reach out to your bankers. So you need to access to your financial system. You need to make sure that your financial systems are well safeguarded, logins, details, and all systems in place are safeguarded. The other thing is to update your passwords regularly. So, and it's common that to require passwords to be updated on every 30 days. You can even do even much sooner, but this able to say protect you from cyber crimes, and also even someone who could have picked up your password somehow, an employee or anyone else. If it's you update your password regularly, then the password they could have gained access to should be, if they come in after 30 days, that password could be expired, it could not be valid anymore. And there you have a safeguard for you. So that's what we're talking about. Update your passwords. The next thing we're going to talk about is reconcile transactions. Transactions don't end after you've purchased your new inventory or sold it to a customer. Implement a process to regularly check transactions against your bank accounts. Include credit card, cash sales, and your purchases and expenses. So we are talking about, it's important to do regular reconciliations of your banks. Regular, as we talked about, reconcile your inventory, reconcile your sales, reconcile your tax. Do not leave transactions at the primary level. You need to go to the secondary level now, which is the reconciliations. And these reconciliations need to be done regularly because they are a monitoring mechanism, and they are safeguards. They are controls around your financial aspects, your physical aspects of the business. So it's important to do regular reconciliations. Check credit card statements. Though you should limit who access to credit cards, it's still an important business control to thoroughly review your statements. How long often do you review your statements? If you do, you'll catch any fraud charges, whether an unknown bad actor captured your credit card information or employee purchased something they shouldn't have. So you'll be able to pick up these things. So if you wait for a whole week before you even have a look at your statements, you may not have, it will be too late to pick up about transactions. Maybe if you need to have access to your banks, even not just in a day, you need to have access to your accounts, to live transactions, especially for huge sums of money coming out or money coming in. So you are able to know what's going in and what's coming out. So this is what we're talking about here. So the next thing is to compare receipts. Part of reconciling transactions should be matching receipts to purchases. You want to confirm that the receipts match the transactions you have post recorded. If you see a transaction but don't have a receipt, that could indicate a fraudulent transactions. So you need to match physical receipts and what is recorded in your systems. So you need to compare. You need to, because this way you'll be able to catch out with fraud, yeah, mechanisms or systems that have been put in place without your knowledge, that have been put up by people, bad actors who could be existing in your business. So you need to compare your physical records and your recorded systems, maybe the POS, yeah, and this is going to to help you in the internal controls of your business. So the next thing is to create a vendor approval process. Vendor approval should be a multi-step process. If you select vendors yourself and list your bookkeeper or other trusted employee to double check the vendor identity. If your employees recommend vendors to you, complete due diligence to ensure a genuine vendor and not a shell created to steal your funds. So you should be able to, when you get vendors in your businesses, suppliers, maybe referred or by employees, you need to verify background check, because some of them could be just conduits or people work colluding with your employees. So you need to make sure you put in place mechanisms to check you as stakeholders around your business, like suppliers, your customers. You understand their business, where they from, their physical location, their banks, you know, you understand so you need to understand your stakeholders, these key stakeholders, because they can be a source of, they can be a mechanism used by bad actors to commit fraud in your business. So the next thing is list all vendors. Create a database with all vendors and contact information. Bad actors or even employees may send false invoices, hoping you'll send a payment. Hoping, check any invoice you receive and the contact information associated with it to verify that you pay only approved recipients. So it's important that you just don't deal with any random suppliers, especially for you thresholds of suppliers, key suppliers, and even smaller suppliers. Just make sure have a system of at least a database of all vendors. And if you receive an invoice from a vendor who's not normal, or your accountant or bookkeeper needs to be able to pick up this and confirm. There should be a mechanism to confirm: is this vendor legitimate? Is this invoice legitimate? And payments should not just be returned to vendors just because they are authentic to the business. So this is what we're talking about here: a database where you can refer information of vendors. You can when you check an invoice, you receive an invoice, you check against the database. So this is it. So the next thing we're talking about, mark all invoices. The more vendors you work with, the easier it is to accidentally pay a vendor twice. Once you've paid an invoice, an internal control is to mark it paid. So, and store it separately from your unpaid invoices so that you don't pay invoices twice. So you mark it paid and put it separately. So have a record of unpaid invoices and paid invoices. This is a straightforward one. So we talk about randomize your reviews. Don't be predictable. You can decide today you have a system in place, but today you decide to start the other way around, or do your checks at a different time than you normally do. So have an element of surprise in how you do your checks and reviews in your business. Then another thing we're talking about, use a point of sale. So a point of sale system is a critical financial control because it manages all transaction and controls who can access and register them. This secures a petty cash and you'll use to provide change to your customers. So this is better than the old manual box. Yeah. So a point of sale keeps keeps a record of all transactions than the manual system. This way we're talking about now we are moving digital. We need to use digital systems. A POS is is has better records and is even faster. And this will help in prevention of fraud. So connect your register to your POS. Your register and your POS should talk to each other. This means your register will only open if the POS gives the signal, which typically only happens if a purchase is made or an authorized employee manually opens the register. This makes it difficult for employees to steal cash from the till. So you need to connect your POS with your cash register. So these need things to be talking to each other. Your register opens when a transaction happens. And the only way this is overridden if there's an employee who has been authorized by the management to override with specific circumstances. And this needs logged the reasons for why this was done. So your register and your POS need to be communicating. Yes. Now we move on. So the next thing, document all transactions. Keep records of all transactions, including customer purchases, your own purchases, refunds, and more. Essentially, you should have a complete record of any money that goes in and out. Your POS will likely do this for you. If you don't have a POS, create your own system for documentation. So here, it's just an emphasis of what the POS will do. It will keep a record of all transactions. So it's important because if you don't keep a record, it's easy for someone to come and defraud you through. They could confuse you and misguide you with wrong information. And and but if you have a record of all transactions, then you are at a strong point and you're able to. This creates a control that is now in your hands to prevent fraud. Then the other thing, establish a backup record. Systems break, malfunctions, or things go offline. Internal controls for small business account for that by creating a backup file. This makes it difficult for an employee or backer to mess with the records by damaging or overriding the systems. So have a backup for your POS, for your sales, for your accounting systems. Because if an employee knows that if the records that are the live records are lost, there is no trace of banks of money, of sales, then a malicious character could destroy the records and reconciliation could be a very difficult part. And this creates an opportunity for theft. So that's why it's important to make sure that we have regular backup records. So the other thing we're talking about is count your register daily. Your point. So make sure that you keep count and a check of your cash of your sales. This is just a further emphasis on reconciliations, counting cash. Make sure that there are no gaps, there are no lapses, and there are counter checks to make sure that the counts are efficient. And this takes us to the next point where you assign two employees to count cash. So they are, because of the human error aspect, so it's important to have a second counter person to counter check what has been done, and this will prevent even if the and this also prevent fraud. If the first employees thought of doing anything, the second employee will will limit the chances of this happening. Yes, we have the aspect of collusion, but if you have this mechanism, then this reduces the level of risk that can exist. And now you have to now just think about how to prevent the collision aspect that can happen. So we move on. So limit access to your cash. Have specific people, otherwise people, yeah, access to your banks, about access to you to anything, your monies that are operating. That's why we talk about a register and a POS, and with only authorized people who can be able to access this. Then next we have secure bank checks. Your checkbook should not just lie open. They should be locked safe, so that, because a blank check is as good as cash. So with so make sure these checks are kept safe, and this will help prevent fraud. Introduce a check signing process. So checks can be an easy target for fraudulent payments. A common internal control is if the business owner is the only person authorized to sign checks for digital payments. If the business owner can't, require two people to sign and approve the check. One of them should be someone you trust. So if the business owner, you're not the one who only signs the checks, the other people sign the checks, then have a system, have two or three people who sign the checks. Now this creates a mechanism of control. So if the first person is fraudulent, there's another person. And this one person should be someone who's very trustworthy. So this another measure that you can put in place. So another thing is use of manual signatures. Now this is it's an old school control to problems arising due to technology. Here we're talking about businesses are increasingly using electronic signatures because they are easy to procure. They are also easy to replicate, which can lead to fraud and unauthorized access. Requiring manual signatures on checks and other documents reduce the likelihood that someone will copy your signature. So here we are talking about that we are not discouraging use of electronic signatures, but um, they're good, but they have limitations. So one will say here, you need to use safe electronic signature technology, and but also we're talking about that manual and uh, technology digital systems can live together and be able to serve each other, because each of them have a limitation. So this is what we're talking about using of manual signatures. So now the other thing is implementing of expense limits. So employers shouldn't make purchases unless they are approved to do so. If it doesn't feel realistic for you to approve every transaction, implement approvals for transaction over a certain limit. So have a limit, maybe petty cash, not above 5,000. Require a manager or a department head above any payment above 20,000. Then another level, if the limit of say 100,000 is exceeded, now a higher level of authority or management is required to come into this case. So this is what we're talking about, implementing expense limits, that so that this is a system of control that make sure that their levels and depending on the materiality of the transaction. So the other thing is to monitor expense reimbursement. So because this is an area that can be exploited by employees. Require that any reimbursements that are received are documented, not just any reimbursement. So there has to be business reimbursements, and these reimbursements should be supported by receipts. Yeah, not hearsay, not stories. But because this is another way that employees can use to defraud the business. And let's face it, this is something that happens. So yeah, so that's what we're talking about, monetary expense reimbursement. So the other thing is that verify reporting accuracy. So regularly review your reporting procedures and confirm that all information is accurate and timely. So you need to make sure that the systems you have in place are serving your purpose, are serving you. And you need to regularly check them, the systems of reporting, because we can have bad reports and good reports. So we need to make sure that what is coming out of the system is good reports, true and factual. And that's why we need to make sure we have the right systems in place, and we need to check these systems if they are okay. So the next thing is to conduct an external review. Though you should internally audit your financial controls and data, you should also seek regular independent reviews, whether from an auditor or a certified public accountant. This person can evaluate your systems with an unbiased eye, ensure you're compliant with relevant regulations, and identify opportunities for improvement. So we're talking about the importance of external professionals, add that eye to what systems you've put in place, because they are less biased. They're not insiders. So when they come in, they look at the whole system holistically. With your guidance, they'll be able to see what the gaps and that could exist and offer advice to your business. So it's important from time to time to have professionals come in and look at all aspects of your business, and they'll be able to guide you on how to make them better. So that is what we're talking about, having external reviews. So the final one is implementing controls technology. As your business grows, your internal control systems will too. Some processes that once worked may not scale across multiple locations or multiple employees, especially if you hired someone to take over a few of your own responsibility. Internal controls management technology can create a more effective infrastructure, automate repetitive process, and evolve along with your business. So as we talked about this before, fraud, risk are evolving. They are dynamic, and technology helps business to keep up with this fact that uh, things are changing, because they'll be more dynamic and be able to keep up to date and help you to adapt to the changing times. So it's important to implement control technology to help you to live up with the changes that are happening in the environment. So in summary, that is what we have talked about. Quite a number of important controls for small businesses, and welcome to review them and look at this recording and pick up on the various points. And you're welcome to put your comments and questions in the comment section, or reach out on our numbers, and we can discuss more on this. So thank you, and trust this knowledge helps us become better at our business management. So that is the end. We've come to the end of this session where we are talking about business internal controls. We have talked a lot about many things, because we believe internal controls are an important aspect of businesses, and the business need to invest knowledge. And this is just a teeny bit in building and making awareness of business internal controls to the business people.